our member room. Hope good to see everybody. Hello, Eric in Northport, Doji, David, Rodney, Michael, Tuna. All right. And Ed Mines with the emojis. Hope everybody's having a very good day. As we dig into this market, keep in mind we are in a very unique and interesting environment, and we have earnings coming off the backside. Hey, everybody, did you know that Disney just took over the NFL network? Oh, God. It's the beyond meats of sports entertainment, everyone. We're going to be digging into what stocks are actually worth engaging in trading today, looking at our breakouts and our breakdowns. We'll also talk about the stocks that just hit our watch list and whether or not this is a safe environment to be trading for the upside, or if it could be another trap day after that wild ride we had yesterday. I want to walk you through exactly what happened with momentum yesterday and give you a little bit of insight into how you can trade reversions based on a day like yesterday. Plus, we'll continue to watch what's happening with the money flow index in the S&P 500 and the Russell to show you where money is positioning. If you're not with us before 9:30, you are the exit liquidity, and I want you to keep that in mind. Good to see you, D. Cox. Good. Hello, Jay Lyons. Good morning, everybody. Thanks for taking the time to join us for the next 30 minutes before Don turns on his playlist. Your top stories today, again, the big focus remains on rate cuts and the expectation that we are going to see the Federal Reserve cut interest rates again in September, currently at about 88% probability of that cut. But I do want to just point out, if you don't know what this tool is, it's very important that you just always know that it's at your disposal. It's completely free. Just go to cmegroup.com, and this is the CME Fed Watch. This gives you the latest probabilities of the next move on the FOMC. So if you are in the business of interest rate gambling, well, this is your place to start. You can also go over to Kalshi, because Kalshi has actually turned out to be a lot more better at predictions than the actual market is, which is kind of wild. But here we go. 89% probability of a 25 basis point cut come September. And what does that mean? Well, once again, basis points, well, 1/100ths of a percentage point. 25 basis points would be 0.25%. And that is based on the Fed funds rate, which basically impacts all borrowing in the United States. Now, why does this matter? Well, because we have been an elevated environment due to the ongoing fight against inflation that had really banged this environment up, the stock market up, over the last few years, only to then turn right back around and completely violate the entire premise of the Federal Reserve. We go back to that period after COVID, which is the S&P 500 ETF, the SPY. And what this is showing you is that after COVID, they cut interest rates to basically nothing. They started pumping money out of the sky, and the stock market went up and up and up like that mountain climber on The Price is Right, only to get us to late November and December of 2021, when the Federal Reserve believed that it would be just enough to raise interest rates from 0 to 0.25% to tame the inflation that monetary expansion had created. Well, we got to this point in March after a sell-off in 2022, and it turns out the market believed Jerome Powell in March of 2022 that all it was going to take was 0.25 basis points or 25 basis points to tame the inflation that might be on the horizon, and then reality sunk in. And we sold off the entire year as we rose toward 5%, and we have remained in an elevated environment. Now, 4.5% to people who remember what life was like before 2008 know that it isn't historically that high. But in the post-2008 world, 4.5% is significant, and it has impacted, obviously, the cost of capital and impacted borrowers across the markets. That said, and this is very important, in late 2022, that people don't really think about was the idea that at that point, people believed that the market was going to continue to decline in 2023. Wall Street analysts, many people, when we were sitting somewhere around 3850 on the S&P 500, firmly believed that the market would move down to 3500, even 3250. But then something happened. And what happened was an expansion in global capacity in global liquidity, shadow banks, hedge funds, private equity firms, private capital began to expand capital in the global financial system at the same time that the Treasury Department started its own intervention in maintaining interest rates on the yield curve, and resultantly the S&P 500 has basically done this ever since. It has violated the protocol of interest rate policy, and it has made the Fed really stuck in a box at this moment. As we pay very close attention to this, recognize that the old metrics, the old views of the market still operate on interest rate policy and what the Federal Reserve is doing. I consistently look at liquidity. I follow the work of people like Michael Howe. I follow the work of Zoltan Posner, and I constantly talk about the fact that there is a lot of money sloshing around in the global financial system, and that ends up pushing risk assets higher. So right now, the only thing that I'm paying very close attention to is the possibility that we have some other issue in the plumbing of the financial system. Lower interest rates would benefit collateral multipliers, make it easier to borrow, make it easier to increase leverage, and would be bullish for S&P 500 outlooks. So completely different worldview, but at the end of the day, basically prepare for more monetary inflation and look for the ongoing monetary cycle to expand well into 2026, which is bullish for risk assets. Just the big question right now is whether or not we are facing any sort of problem in the plumbing of the financial system. Something as simple as a bank in Japan could be under pressure, something as simple as regional banks here in the United States could be under pressure, or an unknown that we don't know about. And that's why we pay very close attention to the momentum reading that we will discuss in a moment. All right, so Jerome Bowles. Woo! Wow, you guys are off and running. Corporate earnings. Arista surges, AMD and Supermicro Computer are suffering. And I want to point out today, very good opportunity with a day like today to really focus on trading reversions and reversals if they come. So what do I mean by that? Well, if you look at the current chart that I have right here on tradingview.com, this is a combination of two things. The first thing is volume weighted average price. Here is your blue line. That is your 1 minute volume weighted average price. And I overlay this with Bollinger Bands to follow 2 deviations of price as we move through the day. What I'm specifically looking for is an environment like this, where we get down to a point where the markets sell off and can bounce and give us an opportunity to try to trade a reversion. This is a very difficult environment for this. But that said, what you're really looking for is a move all the way down into the 3rd or 4th standard deviation of price. And then you're looking for the market to snap back because algorithms are stepping in and covering. On a day like today, SCMI or MSCI or Super Micro Computer, I'll just type that out because I don't seem to know the ticker. SMCI is not having a good time. It's not a good time. Not a good time. All right, but what you're looking for today is the event that this does continue its sell-off. If it gets down here into that 4th deviation of price, to look for a short-term reversal on these stocks. And that can include things along the lines of focusing on Friday's options chain that would expire, focusing specifically around a reversal based on what is at the money or in the money around the $46 level, or just buying the stock and aiming for a move back to volume weighted average price, which is kind of the institutional magnet of the day. You will see a lot of price activity around that 1 minute volume weighted average price today for a lot of the names that are reporting. As I've noted, Disney, ESPN, don't get me started. The only good thing there is, pardon the interruption, they're gonna ruin WrestleMania now, I guess, possibly, and also Royal Rumble, and now they're going to take over the NFL Network. I'm sorry, Rich Eisen. But Disney on the move today. You're going to see some movement on this stock today, but nice to see some pretty wide levels of expectations today on this stock. $12 of movement. So in the event that you see some wild moves. Take advantage of the situation. Look to trade reversals based on these deviation moves. When the market opens, it is likely to see some relatively quick movement from the positioning that was aligned ahead of this earnings report. In addition, you have AMD, not good, disappointing AI unit revenues and export restrictions, and Arista, big move. Huge QE guidance driven by cloud demand. We kind of have this bifurcated environment where some tech is doing very, very well and other tech is doing very, very poorly. Overall, our reading on tech is actually negative, but the bulk of that weakness is coming from the bottom half of the S&P 500 or on the Russell 2000. We still remain strong in the Magnificent Seven as the MAGS, the MAGS, which is an ETF dedicated to our old friends in the Magnificent Seven. It is holding pretty well right now above its 20-day moving average, signaling capital flowing in, MFI remaining above that 50 level. So still strong, but pay very close attention to that MACD, which flipped the table, and the histogram is negative as we move deeper into this week. The ongoing story remains the same. President Trump gets up each day and decides, hey, let's just throw another number up on top of the old gas station figures in terms of what we're going to do with tariffs. This is right, but today we got, 250% moves on pharmaceuticals, and I have a interesting view and argument that, yes, we should be producing our own pharmaceuticals here in the United States. But that said, the tariff policies are what are driving the markets absolutely crazy. So whether or not this creates the incentives to do the production here in the U.S., well, that will be seen. But pay very close attention to the bear-like pharmaceutical companies and pay very close attention to semiconductor companies, because once again, the question is whether or not this manufacturing is coming home. And if this manufacturing is coming home, how does that impact everything from manufacturing stocks to real estate, including the REITs that are involved in industrial capacity here in the United States? Take a little bit of a look, because if this policy does start to work, if this policy does start to win, look at things like industrial REITs like STAG, because once again, the question remains, how successful will this be? And one of the challenges for industrial real estate is whether or not these companies are actually going to commit to the long term, or they're just going to make a bunch of promises right now and then wait and see what happens in the 2028 election. That's always one of the big challenges of being an investor, is policy changes, policy regimes, and we have seen that in spades going all the way back to 2004. All right, let's get to momentum. Stag. There you go. Thanks, Ed. All right. What's strong today? mRNO, VMEO, company that I still am amazed went public because, well, technology gets cheaper and Vimeo televisions get bigger and cheaper as well. I don't know how they make money, but they're doing it, and they're back above their 20-day moving average. This is a company that really is not a good stock, not a good long-term investment, and one of those software application companies that continues to bleed money. The question is whether or not this little short-term pop that it had will be sustainable or not. Keep a very close eye on this 20-day moving average, because if it breaks under its 20, as you will see, look at this channel. Ooh, that is brutal. Just absolutely straight down. But this is a wonderful little stock with a wonderful little lesson for everyone who is learning about technical trading for the first time, or just a reminder, stocks do not go straight down. They follow channels. They move lower. They move through lower lows and lower highs. And as you can see, tracing along that 50-day exponential moving average, Vimeo has not performed very well. I want you to just keep a close eye on this, because if this rolls back over, moving back down into that 360, 350, 320 level is in the cards. It is cheap for a reason. That's right. PHM. Group. Housing stocks continue to show a lot of resolve in this environment. We've been talking about that for a little while. What's important about this is going back to the 13 Ds that we analyzed back in April and May. and June and August. We just do this all the time. Once again, consumer cyclical stocks, particularly around the housing market, have done pretty darn well. Lots and lots of 13Ds, lots of institutional investment, and you have these moves coming off that $90 level. Keep in mind the bulk of the purchases that largely happened in February and March during that weakness that we saw. So we were looking at Q1 levels. Be very cautious once again, because it's entirely possible that a lot of these funds just start dumping some of this stock at some point soon, because, hey, 20%, 25% are sizable gains. They're not holding it because they're trying to create long-term fundamental value. They're buying it because these stocks were cheap, they were high quality, and they were trading at very low metrics. They have rebounded off that April period. But once again, you're seeing these moves off the 20-day moving average. If Pulte retests that 20, look for another short-term move. Again, as stocks go down in channels, stocks go up in channels as well. Profit taking is part of the game. Higher highs and higher lows as you go. What's weak? Well, we're back in the farm and in the software space, and I keep looking at this, and I think this has to go back to the expectations and the speculation around what is happening in the job markets. But this is where valuation does tend to matter. Yesterday in our masterclass, we went through everything, every single fundamental that possibly could matter on a balance sheet. And a reminder that Tesla stock is basically just priced for growth and completely breaks all fundamental expectations, which makes it such a great stock to trade. That said, Snowflake, software application company, monstrous valuation, not even profitable at the moment, but forward PE of 131. Again, these are stocks that are priced for massive growth. And the problem is that in the event that we see this slowdown in the economy, or we see a slowdown in hiring, how necessary are these software applications going to be? On top of that, if they are not AI first companies moving forward, they can be absolutely decimated by disruption. So pay very close attention to this, because when these stocks do break down, they do break down pretty hard. And I prefer to start trying to short them under their 20 and their 50-day moving average. It doesn't take much, and you're right at that line. You've got a wonderful little opportunity right now to set a very tight stop if you are shorting to the downside on software application names like Snowflake. In addition to that, keep in mind that in this environment, again, any economic news that would impact the job market is going to be very, very bearish for a name like this. You have a natural stop baked right in. This is where you take your shots to the downside, and this is where the weakness in the technology space is really persisting, particularly across the Russell 2000. There has been a fly in my office for 2 days, and I cannot get it. It's driving me crazy, but we will keep the show going. Asana, same thing. Same type of name, same type of environment. Dustin Moskowitz will not stop buying his own stock. I guess he's going to buy it until there isn't any stock left to buy. But this stock continuing to break down as well. Unprofitable, more reasonable forward PE of 42, $3.3 billion, and I couldn't tell you what they do. On top of that, VAC and RCL. So once again, in the momentum-driven world that we talk about all the time, remember that these are pure momentum stocks, the cruise line companies. I don't know anyone going on a cruise. I cannot justify any of the valuations, but I do know that when these things break down, they break down hard, much like a company like Tesla, much like anything else in the consumer cyclical space. I have liked this as a short since we pushed under that 335 level. Pay very close attention to that 306 level as a next entry point to take aim, but be very, very cautious of the RSI and the MFI, as most stocks will if they are being heavily shorted and move into oversold both on volume and price. They become very short-term squeeze candidates. What are we looking at for our watch list today? TPH. What do you do? Well, if you've been watching, you know that we're still paying attention to the housing stocks, and you see that strength coming off of Pulte. This becomes a natural point to just simply buy at around the $32 level and around a call, and see what you can do from a move up to maybe 34 or 35. Relatively easy, quiet little way to trade a stock like this. Again, the housing stocks continue to perform. It's been a nice little move. Green Brick is in the exact same category. GRBG BRBK. We'll see if this is a sustainable move or not. But again, it keeps chopping around, bouncing off its key moving averages, creating opportunities to go in the short term and looking to trade within a $5 to $6 range between 62 and 68. FPI, this is not really a trading name. It's just actually nice to see that this is getting a lot of attention again. I am a big fan of this company. This is a farm REIT, but once again, farm real estate had a little bit of a downturn back here at the 1150 level. This isn't really something that you buy. This is something that you really kind of or trade. This is really something that you hold for price appreciation as something as kind of a diversifier away from most other types of assets. But as I have noted before, when this is coming off of sell-offs and we start to see strength on that 20-day moving average, it can get, a $1 or $2 move, 10-15% move in about a month. And it presents an opportunity of relatively low cost, low volume, quiet stock that people aren't paying a ton of attention to. It could just make a nice little move, and it's something that you're going to want to own anyway over the long term. But as I say, no matter what it is, just trade it and trade it around its moving averages. IAG and FSM, you have the materials again back in focus. Always be paying attention to what's going on with the GDX. The GDX, which is the gold mining, had moved back off of its 50-day moving average. And I continue to remind you, just watch that 50-day moving average. Every single time we're bouncing off of this, this has become a buy the dip moment for gold, particularly as we see continued monetary expansion across the global financial markets. So once again, IAG is in focus as it pushes back above these key moving averages. LAND is Gladstone, good company. We're well below those moving averages. I would hold off on that at this moment. All right. So we got to take a little bit of a step back, right? We are in the am nailing it with nail. All right, let's just talk about that real quick. And you're brave. You're a brave person, but this is a thing to watch, not a thing to trade, thing to watch. And once again, as I've talked about the fact that you always want to be watching the LABU when you're watching the biotech stocks, pay very close attention to NAIL. NAIL is the triple bull ETF for daily home builders and supplies. You do not want to be holding this for multiple days or for multiple weeks, but when it moves off these moving averages, if you want to do a multi-day type of trade, you're seeing the last couple of days a solid little move off of this from 57 up to 69. Remember, NAIL will deliver 3 times the short-term return of a traditional housing ETF. But again, when this is above these key moving averages, that is bullish momentum for the broader sector, and that is why we remain positive on Pulte and some of these other names. All right, so momentum checks. As we move into the next couple of days, it's going to be very important to pay very close attention to weekly momentum, right? Weekly momentum. And what I'm focusing on here is pulling back a little bit and looking at something like maybe the UYM. The UYM is the Ultra Materials. It's a leveraged ETF around materials, and I'm pulling back to a weekly chart. The question that we're going to see here is whether or not this is going to break down and remain under this 20-day moving average. I would like, if I'm going to go long on materials, to see on the weekly side this break above that 20. Cannot get that fly. So in this environment, as we're looking out a couple of weeks, the material space is still very muted. And I think this goes back to what Blake was talking about yesterday, and it's a question about the dollar. What is the dollar going to be doing over the next couple of weeks? Will there be continued strength in the dollar? It is hovering right around its adjusted 20. And on the daily side, still showing a little bit of strength, still remaining above these key moving averages with the UUP. A breakout on the dollar is obviously going to be bearish for materials. I'm paying very close attention to this because if that is the case, if the dollar does strengthen into Jackson Hole, well, it's going to put everything on alert. So pay very close attention to a possible pullback on the GDX. Watch copper, watch some of the other more critical materials, including oil and gas. We have a nice little pop today on a lot of materials, particularly in the softs, but I would just simply note that this is a very difficult environment in trying to get a better understanding of what the US dollar is going to be doing. We had that pop, we pulled back to these key moving averages. The question is whether or not this is the start of a new reversion back to the upside. And if the US dollar can get back up to 100 or 102 on the index, it will be quite bearish for these materials. So listen to what Blake has to say. And once again, if you're not paying attention to that, click the link in his 10% per month club, focusing on the dollar and the euro futures. Very critical, very important time to be trading this. There's a lot of lull in this market right now. There's a lot of questions about what's going to happen, and we have to look out to next week. We don't get CPI and all this other data for another week. We don't get another jobs report for a couple of weeks. It is the height and the thick of August. So what is there to trade? What should we be focusing on? Since the dollar and the euro are so critical and focused in what is leading up to Jackson Hole, which is that critical meeting that happens out in Wyoming each year among central bankers, this is going to be a really, really good time to be trading futures, particularly around currencies, and how that will ultimately impact the entire market moving into September. On top of this, we have to be watching other areas of momentum, and what I'm seeing right now, it's going to be in technology. Technology is going to continue to drive this bus moving forward. And right now, technology momentum is largely negative. So what I'm looking at right here is going to be something called the TECS. And the TECS is a leveraged ETF that is inverse, so triple leveraged inverse on technology. If this starts breaking above its 20-day moving average and moving toward its 50-day moving average, that is the big technology names starting to break down, and that is very problematic. That's where the FANG stocks start to lose. That's where NVIDIA starts to get beaten up. And right now, as we're seeing, the money flow index on this is starting to improve. We're going to be paying very close attention to this ADX, and we're going to be paying very close attention to the RSI, because if price movement on this really starts to pick up, it is bad news bears. Ooh, good reference for this market and for the tech side, particularly the NVIDIAs of the world. Technology continues to drive the bus again on the S&P 500. And right now, the weakness that continues to persist in the bottom half of the S&P 500 and the Russell 2000 becomes that canary story. Because as I noted yesterday, we heard that Deutsche Bank, we heard Morgan Stanley, and we heard Evercore suggesting that the market was ripe for a 7% to 10% to 15% pullback. And they were blaming valuations. Now, as you know, I don't worry too much about valuations when there's this much money sloshing through the world, but I do have to be cognizant of something called a paradigm shift. And in the environment where companies like Snowflake or companies like Asana are selling off because investors are looking at them and saying their price does not justify their growth trajectory, what I'm specifically going to be focusing on at that point is looking at the big tech names. Does NVIDIA's valuation matter? Does Tesla's valuation matter? Well, history in the last couple of years has suggested no. But if many people start to assume this and many people start to assess this, what happens is what is known as a short-term paradigm shift. And what happens in this environment is people say, I'm not willing to pay 50 times earnings for this. Somebody else says, I'm not willing to pay 49 times earnings. And then it starts to trickle down and cascade. It just becomes a psychological barrier. Now, it doesn't seem to hold up very long in the post-2008 world, but it is one of those things that kind of runs into social madness. So as I note, just pay very close attention to the TECS, because if this is breaking out, it is signaling concerns at that top level of the S&P 500 tech side and concerns about valuation and concerns about liquidity in the financial system. This will be a very good guide into what could potentially go next. And as you will find, this largely aligns with our momentum readings. When this starts to break up and starts to move quickly, it is a sign that something bigger is happening, and it's usually deleveraging in the financial system itself. Final thing to always keep in mind and always be looking at every single day. And if you're not looking at this chart every day, I can't help you. It is the most important chart in all of finance, and it is what are executives doing with their money. The good news is the executives have been stepping in the last couple of days. CEOs, CFOs, CMOs, insiders, 10% buyers. Strength in this 5-day moving average of insider buying to selling. Now, what does that mean? It means that in the world of finance, in the world of public companies, if an executive wants to buy their stock, they have to announce it. They have to file what is known as a Form 4 document with the SEC. These documents go public within 48 to 72 hours, unless there was a planned acquisition. So if a company sells off greatly after an earnings report, you might see a CEO step in and buy his stock on the cheap, or her stock on the cheap. The point that I'm saying is that I'm always looking for periods where we are all the way up here. Typically, that is where we're seeing a market bottom. And this goes all the way back to 2008. Once again, if you look at the spikes, this is insider buying to selling in total dollars, right? They are putting their money down on the table, and these spikes are going against the fact that executives are always being paid in their stock. So what are these spikes? Well, that's the beginning of quantitative easing in 2009, big policy change. This is the pivot in 2011 around what happened with the European banking crisis. This is the China crisis in 2015, 2016. This is the bond spasm that happened in late 2018. Here's COVID. And then you're seeing these other relatively sizable spikes. These are all meaningful moments in the last 5 to 6 years. The funny thing about it is you're not seeing the buying intensity because these were more sporadic events. Now we're having these flare-ups and freakouts in the financial system every year. So we've had a big event that transpired in 2020. We had Archegos transpire in mid-2021. We had the gilt crisis that transpired in 2022. Insider buying picked up around mid-2023 because of the Silicon Valley banking crisis. And then recently we've had these little tiny pops really tied to what has transpired in global markets. The most recent big move, obviously, was in April. But in the short term, just paying close attention to it, insiders are buying more of their stock. And that is bullish for the market, and it's bullish for individual equities. So as we move deeper into the next couple of days, we'll see just how powerful this trend is, or if they start to walk away from their own stocks. And as I've looked deeper into this, we're seeing a lot of big moves, sizable moves that are dominating this, but also keep in mind that we're seeing a big uptick in filings as well, and that is critical to always note. A lot of pharmaceutical purchases. Dustin Moskowitz is not going to stop buying his stock. Remember, he made a fortune at Facebook, so he's going to keep buying. We're looking at the quality of these insider purchases, and we're also looking at the size of these purchases. CFOs and CEOs buying their stock in the last 10 days. You have names like MSCI, Charter Communications, Fortive, United Parcel Service, Align Technology, Aero Electronics, Merchants Bancorp, Clean Harbors, Tronics, and Marpay. And when I'm on today at 11:30, I'm going to talk a little bit about this. One of the cleaner ways to trade around insider buying and ways that you can exploit insider buying by simply using a relatively simple options trade that has a high probability of success and can be utilized and done over and over and over again, that if the stars align, you can make 100% on your money over the year. All right, so let's wrap it up, everybody. I hope you have a great day. It is 9:20. Don's going to be on with some music momentarily. Once again, if you don't mind, click the link on Blake, 10% per month club. He went 3 for 3 yesterday, had a huge day 2 days before that. This is your last chance before the cutoff. I hope you guys have a wonderful day. Thanks as always for joining us at Market Masters at 8:45. Again, if you don't see it today, I will see you tomorrow live and in the mornings. Have a great day, everybody.